Wow, this is crazy. Guys, let's dive straight into this because I am currently looking at a massive 154% one-year total shareholder return. We've got a stock here that has absolutely skyrocketed over 70% just since the start of this year alone, culminating in an unbelievable $638 billion market cap. We are literally talking about a quiet, relatively low-profile company headquartered in Veldhoven, just a small Dutch town, and yet it has rapidly become the single most valuable technology company in all of Europe by a gargantuan margin. It's completely outpacing all the traditional European economic engines. What is going on here? You are absolutely right to be shocked by those numbers. But if you look at the data here, when we strip away the market hype and look purely at the underlying metrics, this incredible rally is completely rational. It's proven by the numbers. The stock did recently hit a fresh 52-week high of 1,691 euros, which is an incredible rebound from an August low of about 593 euros. But as the balance sheet clearly reveals, the market is not just pricing in your standard, run-of-the-mill cyclical semiconductor upswing. Not at all. Investors are pricing in an absolute structural choke point in global technology infrastructure.
Welcome to today's Explainer, everyone. We are doing a deep dive into ASML Holding today. Every financial headline right now is screaming about artificial intelligence, advanced lithography, and these crazy record stock highs. But as your resident devil's advocate, I promise you, we are going to cut right through those AI buzzwords to uncover the hard, cold financial realities. Are we looking at the ultimate buy and hold strategy for the next decade, or is this just a giant valuation bubble waiting to pop? Well, the answer doesn't actually lie in the AI hype. It lies strictly in their balance sheet, the durability of their technological moat, and the rapidly shifting geopolitical landscape. We are going to let the historical and forward-looking data entirely dictate our verdict today.
Here's our agenda. 1. The AI chip toll booth. 2. Financials, looking at growth versus valuation. 3. Geopolitical moats and risks. And 4. 3 investment scenarios. Let's jump right in.
Section 1. The AI chip toll booth. Uncovering the hidden causes behind the rally.
Okay, so every single day my feed is flooded with ASML hitting new highs, and it's making me anxious. I need you to uncover the real, hidden causes behind this massive tech rally. Because it cannot just be people shouting the word AI driving a $638 billion valuation. You're absolutely spot on. A valuation of this sheer magnitude requires concrete, fundamental shifts in the business environment. It's proven by the numbers that there are 3 distinct catalysts driving the current surge, and they are entirely unique to this specific market cycle. First, we are seeing synchronized logic and memory chip demand. Now, historically, capital expenditure in these 2 semiconductor segments moves completely out of phase. When one is up, the other is usually down. But the AI basic role and core objective requires massive logic processors to be paired directly with high bandwidth memory, or HBM. To prevent data bottlenecks in AI processing, you literally have to stack memory chips vertically right next to the processors. This fundamental shift forced SK Hynix recently to place a massive multi-year order for EUV systems worth more than $7 billion.
Wow, $7 billion just from one player?
Exactly. Second is the commercial ramp-up of high-NA EUV machines. Intel recently confirmed that its 18A process node is in risk production. That data point proves this highly complex, sub-2 nanometer technology is successfully moving from the research lab right into the commercial fabrication plants. And third, we are looking at supreme management confidence. ASML has an ongoing massive $12 billion share buyback program. In Q1 26 alone, they repurchased around $1.1 billion worth of shares. Just to put that into perspective, during one recent week, they were spending nearly $16 million every single day just buying up their own stock.
Now, to truly understand why those 3 drivers are so incredibly potent, we have to grasp their underlying business model. Think of ASML as the only functioning bridge across a massive, uncrossable river. Every single tech giant out there, whether it's NVIDIA, AMD, Apple, or Microsoft, needs to get their cargo to the other side to build their AI infrastructure. ASML designs and manufactures extreme ultraviolet, or EUV, lithography systems. They use incredibly complex light mechanics to print microscopic patterns onto silicon wafers. And here is the kicker. There is zero alternative on the global market. None. You simply cannot build an advanced AI data center without paying ASML their toll first. To give you a real sense of the precision we are talking about, the mirrors inside these machines, manufactured by Zeiss, are so flawlessly smooth that if they were scaled up to the size of the Earth, the highest mountain on that Earth would be less than a millimeter tall.
Wait a minute, doctor. What does a toll booth have to do with our stock accounts? I mean, I love a good bridge analogy as much as the next guy, and that merest statistic is completely mind-blowing, but we need hard facts. How does this abstract toll booth concept actually translate into actionable investment grounds for the people watching right now? Show me the actual money.
Section 2, Financials, diving into the balance sheet.
Okay, let's crack open the Q1 ledger and look at the actual cash. ASML reported 8.8 billion euros in total net sales for Q1 of 2026. That landed perfectly within their prior guidance. Furthermore, they generated a solid net income of 2.8 billion euros. But what is exceptionally strong here, if you look at the data, is the gross margin, which came in at 53.0%.
Over 50% on physical hardware?
Precisely. And that margin increase was driven largely by their installed base management sales, which hit nearly $2.5 billion. This is absolutely crucial to understand. Installed base management is essentially the servicing, upgrading, and providing of software enhancements for the machines that are already sitting in factories. It functions almost exactly like a recurring high-margin software subscription business layered right on top of their massive hardware sales. Because global AI demand is constantly outpacing chip supply right now, these chip makers are desperately accelerating their capacity plans and squeezing every single ounce of performance out of the ASML machines they already own. Consequently, ASML management has confidently issued a full year 2026 revenue guidance between 36 billion euros and 40 billion euros, maintaining a very strong gross margin expectation between 51% and 53%.
Okay, wait, hold on just a second. I am looking at the balance sheet right now. They are making incredible money on the top line, and like you said, a 53% margin is totally huge for a hardware manufacturer. So why is the market completely going wild and ignoring the fact that they are running a massive deficit? In Q1 2026, ASML reported a deeply negative $3.08 billion free cash flow. How on earth is an absolute global monopoly bleeding over $3 billion in a single quarter?
It's a very critical question, and frankly, it's one that often scares away retail investors who don't read past the headlines. But a closer, rational look at the corporate filings shows this deficit is entirely a function of strategic timing, not a fundamental failure of the underlying business. According to their CFO, Roger Dassin, during the Q1 earnings call, that negative free cash flow was largely driven by the timing of massive down payments. Remember, a single advanced EUV machine costs up to 400 million euros and takes anywhere from 12 to 24 months to physically build. ASML is investing incredibly aggressively in inventory and factory capacity expansion right now. They are aiming to deliver 60 low-NA EUV systems in 2026, and they are targeting an output of 80 units by 2027. They have to buy the advanced lasers, the complex optics, and the mechatronics literally years in advance. So this cash outflow is simply front-loading the raw material costs of a booming, multi-year capacity order book. It's proven by the numbers. They are tying up cash today strictly to guarantee their absolute future dominance tomorrow.
Okay, I understand front-loading the cost. That makes business sense. But even if the deficit is temporary, I have to ask you about this valuation. They are making good money eventually, but why is the stock price like this? They are currently trading at a trailing price-to-earnings ratio of 63.7. That is an extreme premium for a company with severe single customer concentration risks. They rely super heavily on just a few giants, like TSMC, Samsung, and Intel. Plus, they have a massive geopolitical target painted right on their back. Why are investors so incredibly eager to pay this much of a premium?
Because context is everything in valuation. Yes, a 63.7x PE ratio is historically rich for a hardware manufacturer, no doubt about it. However, if you look at the data here and compare it to the wider landscape, it actually sits slightly below the broader US semiconductor industry average, which is currently sitting at 68.3x. It's also lower than its direct peer average of 66.7x. The market is very smartly pricing in the fact that ASML's order visibility stretches across multiple years. That multi-year visibility heavily dampens the typical boom and bust cyclical volatility that usually plagues the semiconductor industry. Now, to be fully transparent, it is true that quantitative models suggest a lower intrinsic value. For instance, a discounted cash flow, or DCF model, which essentially projects all the future cash a company will ever generate and discounts it back to what that cash is worth today, suggests an estimated fair PE of around 52.7x. That means on a pure fundamental cash basis, ASML is technically fully priced or perhaps slightly expensive. But institutional investors are more than willing to pay that specific premium for one simple reason: the total and absolute absence of global competition.
So what you just said basically means they are expensive, but they're still relatively cheaper than their peers simply because they completely own the market. They are literally the only game in town. Exactly. The financial markets always assign a very heavy premium to absolute monopolies.
Section 3. Geopolitical moats and risks.
And that brings us perfectly into the geopolitics. Because as we all know, being the only game in town means every single government on planet Earth wants to control your board. Let's look at this $400 million technological weapon they've built. The ultimate economic moat here is ASML's next-generation high-NA EUV technology. As we can clearly see from their continuous and massive R&D capital expenditure, this isn't just a minor iteration of an old printer. It is a complete manufacturing revolution. These new machines cost between $380 million and $400 million each. To put that scale into perspective, they are literally the size of a double-decker bus, and they require multiple Boeing 747 airplanes just to ship a single unit across the world. It has taken over 3 decades and more than $40 billion in dedicated research and development to reach this exact point. More importantly, the supply chain required to build it is historically rooted and virtually impossible for any competitor, like China's SMIC for example, to replicate. ASML relies on a hyper-specialized global network. You have perfect Zeiss optics coming from Germany, incredibly precise Cymer light sources coming from the US, and advanced mechatronics engineered in the Netherlands. No single nation can copy it. ASML has already successfully shipped 2 of these high-end systems this year. This specific technology will confidently extend Moore's Law well into the next decade, making ASML completely irreplaceable for all future sub-2 nanometer AI chip manufacturing.
Okay, that technological moat is undeniably incredible, and the logistics of needing multiple 747s just to ship one machine really highlights how insanely complex this is. But let me play devil's advocate here for a second. The fatal weakness has to be the regulatory risk. I'm looking at the U.S. Match Act, which is currently moving through Congress. It threatens to completely close the loopholes allowing ASML to ship their older DUV, deep ultraviolet systems to China. And even more devastatingly, it aims to ban the ongoing servicing and maintenance of the machines that are already legally installed and operating in Chinese fabs. How can any company, even a monopoly, survive losing one of its absolute biggest, most profitable geographic markets literally overnight?
It's a valid concern, and the China risk is undeniably real. But if you look at the internal metrics, it's proven by the numbers that this risk is actively shrinking in proportion to their total business. In the first quarter of 2026, China's share of ASML system revenue fell sharply to just 19%. That is down significantly from 36% in the prior quarter. Management forecasts that it will stabilize around that 20% mark for the full year. Furthermore, that massive $36 billion to $40 billion revenue guidance band for 2026 we discussed earlier, that was intentionally made wide specifically to accommodate any further potential losses from these expanding geopolitical export controls. Because here is the fundamental reality. What ASML loses in legacy Chinese DUV sales and servicing, they are more than making up for with absolutely explosive demand for those high-margin next-generation EUV systems in the West. Foundries like TSMC, Samsung, and Intel are locked in a desperate race to build out sovereign AI capacity, backed by government subsidies. That massive surge in Western capital expenditure completely masks the localized financial damage from the export bans to China.
So, what you just said basically means they are sitting at the absolute peak of global geopolitical tension, but they are successfully trading a legacy China risk for explosive Western AI demand. The West literally needs them so badly that it's masking all the financial damage from Washington's export bans. Okay, I fully understand the past and the present now, but where are we going from here? Section 4. Investment Scenarios. Bull, Base, and Bear Cases.
All right, that brings us to our final stage today. We've distilled all of this crazy data, the supply constraints, the financials, the massive technological moats, and the extremely complex geopolitics into 3 strict forward-looking survival scenarios. Show us the data-backed futures, Doctor.
Absolutely.
Let's start with the bull case, the most optimistic scenario. The required trigger here is twofold. High-NA EUV production must scale flawlessly without any manufacturing defects, and the synchronized demand for both logic processors and high-bandwidth memory chips must sustain throughout the entire AI supercycle. Furthermore, we need to see wildcards like Elon Musk's massive $119 billion terafab project actually materialize, requiring huge unexpected lithography orders. The outcome? Bank of America has set a price target of €1,921. In this scenario, ASML reaches its 2030 upper-end revenue target of €60 billion much earlier than expected. Based on current AI hyperscaler capital expenditure guidance, the feasibility of this scenario is quite high. Okay, so that's if absolutely everything goes perfectly, and tech giants just keep spending billions on AI infrastructure without blinking. But what is the realistic baseline here? The base case is the neutral, and statistically the most likely future based on the current order book data. The trigger here is simply that global chip supply continues to lag behind demand for the next 2 to 5 years. This is exactly what ASML CEO Christophe Fouquet is officially predicting.
In this scenario, ASML successfully manages the geopolitical export controls, adjusting their complex supply chain within their stated margins. The outcome is reliably hitting that 36 billion to 40 billion euro revenue guidance for 2026 with a solid 51% to 53% gross margin. This is followed by steady, predictable, monopoly-driven growth for the rest of the decade. Makes sense. And what about the downside? What happens if the worst-case fears materialize and this massive geopolitical tightrope snaps? That brings us to the bear case, the pessimistic scenario. The trigger here is that the U.S. Match Act fully materializes into law, entirely and immediately severing all of ASML's China servicing revenues. Remember, those are highly profitable software and maintenance contracts. Simultaneously, those massive upfront capacity investments we discussed earlier would lead to persistent quarter-over-quarter cash flow deficits, right as the broader AI chip market faces a sudden cyclical downturn or digestion period. The outcome? Valuation models would aggressively revert strictly to fundamental cash flows. As we noted, the Simply Wall Street DCF model places the intrinsic future cash flow value at just $740 per share. As Morningstar noted in their recent sell downgrade, this represents severe valuation risk if absolute perfection is not achieved by the company. However, because this requires a synchronized collapse of multiple AI growth vectors and a total chaotic global decoupling, it's proven by the data that the feasibility of this worst-case scenario is currently moderate to low.
So, what you just said basically means the upside is incredibly vast and highly probable, but the floor could fall out severely if global geopolitics completely overwhelm the underlying technology. Honestly, I think that perfectly leads us to the ultimate summary for this entire explainer. As the legendary Warren Buffett famously said, the stock market is a device for transferring money from the impatient to the patient. With ASML, you are quite literally buying into a multi-year, multi-decade technological monopoly. You are choosing to pay a hefty premium today for a highly advanced toll booth that every single AI data center on Earth must cross tomorrow. But you absolutely have to be patient enough to weather the violent geopolitical noise and those temporary cash flow deficits along the way.
And that officially wraps up our deep dive into ASML's fascinating financial realities. We really hope this explainer gave you the hard, objective data you actually need to cut through all the crazy AI hype out there. Thank you so much for joining us for today's explainer. Your subscriptions, your likes, and your supportive comments are a huge encouragement for our entire analytical team here. So let us know down in the comments below. Do you guys think ASML's irreplaceable AI monopoly justifies that massive premium price tag? Or will the geopolitical news coming out of Washington tighten way too much for them to keep growing? We can't wait to read your thoughts, and we will see you in the next explainer.